It's been the story of real estate over the last, we'll call it 2 years. Interest rates, they have not done well. We finally have some good news, though, over the last 2 weeks. We're going to talk about the levers that got pulled that actually brought the interest rates down a half a point in just 2 weeks, could salvage this spring season. And more importantly, as we look forward, could we see even more drops going forward? If you're looking to buy, you definitely want to check out this video because we're talking about mortgage rates. Hey, everybody, this is Steve, Real Estate Agent, EXP, with Malone Home Team here in the North Atlanta area. Start out by saying, if you wouldn't mind liking and subscribing so we can keep the ball rolling with the SEO and kind of get in front of more people, especially people looking to buy and keep up with what's going on in this market. We're going to talk about what's going on in this market because this is the thing everybody's asking about, mortgage rates and what that means for the housing market the rest of the year. So we're going to break it all down. First, we're going to go deep into the numbers and talk about the three levers that we watch when it comes to mortgage rates and why in the last week we've had three really good reports that have all led to a half-point drop in just a couple weeks in mortgage rates. Okay, that's the good news. That's number one. Number two, we're also going to look forward at what the feds are thinking is going to happen and what we think is going to happen going forward. Okay, so we'll take a look at, kind of future pacing, what's going to happen. Anybody who was on Instagram saying, oh, I think their interest rates are going to be in the fives by summer, I think those people were smoking you know what, all right? So we're just gonna talk about what we think is going to happen going forward, and then we're gonna end this by talking about if you're looking to buy. I think it's thread the needle time. Okay, I think that there's a unique opportunity coming in this next month. Okay, we had something very similar back in December and January. You have that potential right now because I think once these rates go a little bit lower, I think everybody's off the sidelines. Maybe not everybody, but a whole bunch of people are going to be back off the sidelines, jumping in the pool. I think things are going to change. So we're talking about your unique opportunity you have coming up. So let's break it all down. Look at the numbers. Look at the future, what it means for you. Let's roll. So let's talk about the three levers that have really pulled in the direction of actually bringing the rates down a half point in the last 2 weeks. It could lead to even more drops as we head towards the end of May, beginning part of June. All right, so first off, U.S. job growth. This dropped this past Friday. Okay, so job growth totaled only 175,000 in April, much less than expected. The unemployment rose to 3.9%. Say it all the time. Unemployment. If the unemployment goes up, meaning more people are unemployed, that's bad economic news, great for mortgage rates. Okay, if the unemployment rate's way low, the unemployment rate being way low is an indication that the economy is rocking and rolling, and the economy rocking and rolling can support higher mortgage rates. So with the feds trying to raise their rates, where they borrow money or the banks borrow money to each other, if the feds raise their rates, it quiets down the economy. Economy comes back into check. It's taken longer than they expected, but the economy is coming back into check. Okay, so the mortgage rates are reacting to that news by seeing that more people are unemployed. Unemployment between 4 to 5% is where they would like it to be. They'd like it to be closer to 5%. That's more of like a healthy number, but above 4% would really be a big indication that the unemployment is more under control, the economy is under control. So that's one lever that we watch is the unemployment. The unemployment had a better report for mortgage rates on Friday. Again, we're not rooting for people to be out of jobs, but we are saying if the unemployment rate goes up, meaning more people are unemployed, that means that the mortgage rates are going to come down. So that's lever number one. Lever number two happened yesterday on Wednesday. CPI report came in showing that the inflation is easing. Consumer prices still rising 3.4% from a year ago, but not at the numbers everybody was expecting. The inflation actually a little bit cooler than expected. So that was number two. Last month, we had a inflation report that was pretty close to expected, which was still pretty warm. We also had an employment report that was a little more indicative of a strong economy. That's what sent the mortgage rates in April way up. Mid-sevens. These two reports back-to-back bring the mortgage rates back down. Now we're in the upper sixes. So that's the number two. But the third lever, this is a surprise lever that happened in April. This is within that same report. You go scrolling down, and this is a big one. This is one that we need to watch. Got to highlight it right here. Another economic news on Wednesday, the Commerce Department reported that retail sales were flat. They were expecting a 0.4% increase. You get an increase every month, seems like. But they came in at 0.0%. So people are not spending as much money. Again, an indication of a slowing economy. That is good for mortgage rates. So bad economic news, good for mortgage rates. Okay, so we have three reports over the last week or so that have indicated that mortgage rates are on the way down because the economy is starting to cool off a little bit. So the Feds, we talk about this all the time, the Fed funds rate and the mortgage rates are two separate things. Okay, I want to show you what's going to happen or what the expectation is to happen coming up at the next Fed meeting. Because the Fed's going to set their rate. Their rate is 525 to 550 right now. Okay, the odds are right now there's a 91.3% chance that that's going to be the number that they leave the next meeting at, June 12th. They're likely not going to change then. Worth looking though, what happened over the last month or so to those numbers? Let's hit the compare button, I should say. So right now we're at 91.27%. Just yesterday, that number was at 97.09%. So a much different situation, still above 90. So I mean, more than likely, we're not going to see a mortgage rate or the Fed drop their rate once we get into June. But you know, it's been holding in that 82 to 91 to 97 to 91. So more than likely, we're not going to get any drops. What is more than likely going to happen? Because when we go into July, take a quick look forward. Let's just look at the conditional, what the plans are. Once you get into July, 69% chance we're going to stay where we are, 29% chance we go down to 500 to 525. September's the big one to watch. That could be the one that right now they're saying 50% chance they drop in September, right before the election. I'll let everybody decide what they want to decide about that. 31% chance they stay where they are, 16.8% chance that actually is going to be in that 475 to 500 range. So there you go. Let's look at the probabilities, the square that we look at here. So here we go. Again, 525 to 550 on June 12th. That's 91% likely, 68% likely it's going to stay that way at the end of July. Then you drop one. There's a 50.5% chance you get one drop there, holds there in November, and then a 37.5% chance you get a second drop in December. All right, and then maybe get another drop once we get into March. This is going to be all over the board. The one thing worth noting, though, is that there's never been a moment where the Feds have shown that they may actually jump back up. The Feds are holding where they are. It's just a question of when they're going to let their foot off the gas. Today, it looks like it's going to be that day, September 18th. That's when they're going to let the foot off the gas. Now, what does that have to do with mortgage rates? They are watching the economy. Okay, they're watching what happens with unemployment, with inflation, and with consumer spending. Okay, those three levers we talked about. The two big ones are the inflation and the unemployment, but consumer spending is kind of that third, kind of that magical lever that nobody wants to talk about. They're watching those. Okay, when they drop their rates, that's an indication that they are satisfied with where the economy is, heading in the right direction. Okay, the mortgage rates run in tandems, it seems like, with the Fed funds rate, because the mortgage rates are watching a lot of those same economic data, things like that. So when we see these drops, these are going to kind of paint the way of where the mortgage rates are going to go. And I think it's going to be a slow and steady descent the rest of the year. So where are we right now? 30-year fixed mortgage rate, okay? We're going to look, this is the last year, okay? And we've been here, what was it, about a year ago, we were at 6.5 and everybody thought it was high. And of course we got to about 8 and change back in October. Everybody flipped out. And we had the big drop down to, like, we had about a 0.5% drop in a couple weeks. And we had another 0.5% drop once we got towards December. So we dropped about 1.5 points in about a month and a half. It was kind of nice. We had a lot of, everybody was thinking things are really picking up as they head into spring. And then, of course, then the interest rates started going up, 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 up. We got back to 7.5%. Now, here's the interesting thing to note. This was April 30th. We were at 7.5%. This is May 16th. Coming out of May 15th, we were at 6.99%. We dropped 0.5% in 2 weeks, okay? So we're in the neighborhood of getting back into the mid sixes. Don't get too terribly excited about what we're going to do next. I don't think we're going to end up like 6.5, low sixes anytime soon. But I think we're going to set up for something in the mid to upper sixes. as we head throughout summer, and then just a slow and steady descent. It's going to mirror this right here. Again, earlier this year, we had where they were thinking we were going to have, or some people were thinking. I have some people who told me I was full of crap when I said, everybody's thinking there could be 4 to 6 drops, and they said there's no way it's going to be 4 to 6 drops, and they were right. But I'm not going to tell you your name if you're watching this, so you're just going to have to acknowledge me when you see me. Anyway, but I say that to say, right now we're only going to get 2 drops, potentially. See how it plays out. Another one once we get into March or April. It's a slower process. So the Fed's dropping theirs at a slow, steady process is going to mirror what happens with the mortgage rates. Slow and steady. We're going to end up in the mid-6s, low 6s, maybe by the end of the year, okay? If we end the year at 6.25, or close to 6, I'll do a cartwheel through this office, okay? That would be great. That's going to really salvage the housing market, help some of these new home buyers who can't afford stuff at 7.5%. We had the last month has been just brutal in real estate. Heard so many stories of people who get under contract because they got locked in at 6.5%, right? And then they go to buy, they get something under contract, and they say, well, guess what? Remember when you locked in at 6.5%, or you got pre-approved, I should say, at 6.5%? Yeah, now it's 7.5% because you didn't lock in. It was just a pre-approval. Then they see what they own, they're like, holy crap, and they cancel. Right? We had a couple of those where they had the estimate, then they go under contract and they say, well, yeah, the rates have gone up like crazy. This is your new payment. They're like, holy crap, I can't afford that. And then they terminate, like right out of the gate. We're seeing that a lot. The hope is that now this is going to salvage this last half of the spring season and summer season, hopefully with rates back in the 6s. That's going to bring the buyers back. What happens next if you're looking to buy? As we look towards the end of the year, okay, from this point, we're recording this mid-May through the end of the year. What's going to happen? Okay, we kind of alluded to it. I think we're going to have a slow and steady drop from here. We're going to have some wobbles. Are we going to end up above 7? Probably. Momentarily. I don't think we get back to 7.5. Maybe get to 7.25. I could be 100% wrong. I think I've said that about 2 or 3 times already, and I was wrong every time. I'm going to say it again, and eventually I'll be right. But I don't think that we go appreciably higher than where we are right now. I think we're on a slow and steady. Now, I don't think that we get below 6 this year. It just doesn't look like it. The economy is slowly coming in, and it's slowly leaning in. The Feds are kind of showing their hand as what they're going to do. They may do 1 or 2 drops this year in their rate because they're looking at the economy. They're saying the economy is slowly coming back into check. We're going to slowly come back with it. Mortgage rates are going to slowly come back with it. Everybody's pacing is going to be exactly the same, okay? Now, that's something could happen. You have a major event happen worldwide. That's going to throw everything off. I don't know what it is. There's a lot of international tension right now. If the U.S. gets pulled into something like full scale, all bets are off. You never know what's going to happen. But as far as what's going to happen on paper, looking at what's happening right now, that's what it looks like right now. Slow and steady. Okay, so what does that mean for you if you're looking to buy? Right now, as you look at everything, and this isn't Atlanta. It's different everywhere else in the country. Some spots are way up, way down, way up, way down. In Atlanta, it's slow and steady. That's the theme, okay? So you got slow and steady growth on prices in Atlanta. So if I'm buying a house today, in a year it's going to go up in value, 5 to 7%. Depends on where you buy it, depends on what you buy, all that stuff, okay? But on average, we'll call it 5 to 7%. So regardless of what the rates are. So if you buy something now versus you buy it in a year, yes, it's going to be more expensive. You may have lower rates. But the problem is with the lower rates, it also brings in more people. Harry Habib, who's an economist, famous economist in the U.S., mortgage guy, and he basically came out and said, for every 1 point that the interest rate drops, you get 5 million more buyers. Okay, so if you had a recession, I think 1.5 million people are going to lose their jobs, but 5 million people are going to jump back into the pool because interest rates are going to go down about 1%. During that, that's what typically happens. So every percentage drop, you have 5 million more buyers. Okay, so if the houses are going to go up naturally anyway, because that's what happens with houses, they go up in value. But if they go up in value and you add the fact that you're going to have a whole boatload more buyers in there, You're going to have multiple offers. You're going to have all kinds of craziness. The prices are going to get even more inflated. People may be waiving inspections, things like that. Okay. So right now you have the opportunity to get, it's not a great rate, something in the upper sixes. I mean, historically, it's a great rate when you compare it. But I mean, obviously a lot of people are 2 or 3%, right? So yeah, upper sixes is not a great rate, but you get it now. Upper sixes, it's definitely better than it was when it was 8 last year or 7.5 just a couple weeks ago. You get 6.75 maybe, okay? And then you get it at a cheaper price. Or you could wait 2 years until the rates are in the fives. You buy in the fives in 2 years and then you refi, or you buy in the fives in 2 years. Your mortgage rate's going to be, or mortgage payment's going to be pretty close to what the mortgage payment would be right now, okay? Or you could buy it now, refi in 2 years, and you refinance. Let's say it's a $500,000 house, right? $500,000 house. You buy it now. In 2 years, it's going to be worth $560. Let's just say $560 for poops and giggles. So it's worth $560, right? So what is the better payment? You want to refinance and pay a $500,000 house at 5.5%, or do you want to buy a $560,000 house at 5.5%? I'd rather refinance a $500,000 house. Get the house now, ride the equity train up, okay? Add that $60,000 to your net worth, okay? That, to me, that makes the most sense. Everybody's different, okay? So, I mean, if you're not in a position to buy, you're not in a position to buy. So, I'm never going to tell anybody, you have to buy, renting's dumb, blah, 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 all right? Renting is not dumb, okay? Sometimes we have to rent because it makes the most sense, okay? I'm saying as a long-term plan to build your legacy, to build your savings, to take care of your family, buying a house is a huge part of that. Owners of homes have a 40 times higher net worth than renters. It's a study they did, 40 times, okay? So I want everybody to get on the equity train when they can, all right? So if you're thinking about it, whatever, I think that this is a great opportunity because there's more inventory right now. There's not fist fights in the parking lots right now, okay? This is a good time to get in, get an okay rate, refi down the road. You're going to refi at a lower price than if you were to buy it, 2 years from now. So that's if I was buying right now and I was looking for the perfect spot, that's the thing you got to keep in mind. There's no perfect spot. The perfect spot is when the rates are at 2.75% and all the home prices will come crashing down. That's not going to happen. Okay, that's the perfect spot and it's not going to happen. What I want you to do is get the most advantageous spot for you. The most advantageous spot is for you to get in as quickly as possible so you can get on the equity train. Because that house is going to go up $60,000 in value. So it's either the owner of the house right now, they're going to get that 60, or you can get that 60. Okay, so grab the house, it goes up in 60, you refi, and then you're on your way. Okay, there you go. That's my piece. That's my thought. If I'm wrong, let me know. If you have questions, more importantly, let me know. Email is below. Give me a call, 470-233-4409. Love talking about this stuff. And we're going to be watching this every month, what's going on with the mortgage rates, all right? Don't forget to like. Don't forget to subscribe. This is Steve, Malone Home Team, EXP in Atlanta. Take care. Have a good day.